Welcome to a deep dive into a massive financial move from China that's making waves across the globe. China is facing a major debt crisis, and they're addressing it with a $1.4 trillion debt swap plan. Let's explore what this means and how it could impact the world economy. China's economy is huge, worth $18 trillion. However, local governments have accumulated massive debt, particularly tied to infrastructure projects. This debt is linked to local government financing vehicles, LGFVs, which borrow money for projects like roads and bridges. Here's the problem. Many local governments relied on land sales to pay off debt, but with a slowdown in the property market, revenues have dried up. The debt burden is growing, with the Chinese government estimating it at 14.3 trillion yuan by the end of 2023. The IMF, however, believes the real debt is closer to 60 trillion yuan. To solve this, China has unveiled a $1.4 trillion debt swap plan, designed to swap high-interest debt for lower-interest bonds. This provides temporary relief by reducing the debt burden and gives local governments more financial flexibility. This plan will run through 2028. The Chinese finance minister, Lan Fouan, has also indicated that China will adopt a more aggressive fiscal policy in the coming years, including raising the official deficit to boost economic activity. China's financial decisions have global consequences. As the world's second-largest economy, any shift in its financial strategies can impact markets worldwide. Moreover, the re-election of Donald Trump as U.S. president raises concerns about the impact of new tariffs on Chinese exports. If tariffs are imposed, China will need to boost domestic demand to offset export losses. This debt swap is one of the ways they are attempting to stabilize their economy, but it won't be enough on its own. Despite its size, the market did not react positively to the news. The offshore yuan dropped, and bond yields reached their lowest levels since September. It shows investors are uncertain whether this plan will lead to real economic growth. Xi Jinping has identified local government debt as one of the biggest risks to China's economy. While the debt swap plan is a step in the right direction, it's only a temporary fix. China will need significant fiscal reforms to ensure long-term stability. Reforming how local governments are funded is critical. The current system relies too heavily on land sales, which is unsustainable. To prevent future financial crises, China needs to explore new tax policies and financial systems to support local governments. The real test will come in December, when China's top policymakers meet for the Central Economic Work Conference. Many expect China to announce additional stimulus measures to keep the economy growing. Analysts suggest that China may need to spend an additional 12 to 13 trillion yen over the next few years to offset the impact of potential new U.S. tariffs. That's a significant sum, and it shows that China is ready to take bold steps to prevent a slowdown. Key takeaways. China's $1.4 trillion debt swap plan is a crucial move to reduce local government debt, but it's not a full solution. The swap plan helps in the short term, but requires broader fiscal reforms for long-term stability. With Trump's re-election and potential tariffs, China must strengthen domestic demand to maintain growth. The markets didn't respond positively, reflecting concerns about the plan's effectiveness. China's next steps will be crucial, especially during the December economic meetings. While this $1.4 trillion plan is important, it's just one piece of a larger puzzle. We'll need to watch closely to see how China continues to navigate its economic challenges. If you found this video helpful, please like, subscribe, and turn on notifications for more content on global macroeconomics and finance. Stay tuned as we break down key financial events worldwide. Thanks for watching.